Ladies and gentlemen, this is your captain speaking. Welcome aboard the Financial Independence Podcast.
G'day, and welcome to another episode of Captain Fi, the Financial Independence Podcast, where I open the cockpit to some of the best and brightest in personal finance, as well as those who have reached or are on their way to financial independence. Before we get started, remember, nothing said here is financial advice, and you should always do your own independent research before making any financial choices. With that being said, I hope you enjoy the episode and learn something new. This podcast is brought to you by the best portfolio tracking tool for Aussie investors. ShareSite makes it incredibly simple to track your portfolio with automatic updates of share purchases and dividends, easy-to-read graphs, and comprehensive tax and performance reporting, all wrapped up in an easy-to-use cloud-based system. For users with fewer than 10 holdings, it is completely free, and I even used the free version for years. Head over to captainfi.com/ShareSite-review to see if ShareSite is for you. Captain Fi listeners can score themselves 4 months of ShareSite Premium for free by using the bonus sign-up code in the article. If you do ever decide to hold more than 10 stocks, be sure to use this code to get your first 4 months for free. Even if you do only plan to use the free version, using the code means if you ever do upgrade, you'll still get your 4 months for free. Ditch the Excel spreadsheet and complete your tax with a click of a button by signing up today. That's captainfi.com/ShareSite-review for your 4 free months. On board today is Andy Darroch. Andy runs Independent Wealth Advice, an independent financial advice firm that provides fixed, upfront fees for a statement of financial advice. He has a degree in accounting and is a CFP. He's also worked in wealth management for over a decade, including at Macquarie Bank and at one of Australia's oldest stockbroking firms, Wilson's Advisory and Stockbroking. So suffice to say, he's got a bit of experience. He is also a self-professed, self-loathing financial advisor, which I find funny. He has some fairly controversial views on the financial advice industry, not being afraid to call out shitty or unethical products when he sees them. He's even written several exposés on how the industry at large doesn't do right by its clients. Having said that, it's Andy's belief that you can still get good financial advice for a fair cost without conflicts of interest that can have a phenomenal impact on your long-term financial success. He even goes so far as to say that it's incredibly easy to sort out your finances and set yourself up for life, even without professional advice. So, if you want to avoid getting stung by fees and some shitty financial products, and you're looking to hear about some areas with low-hanging fruit, you can get some easy wins to help set yourself up financially, this episode might just be for you. Andy, welcome, mate. Tell us a little bit about yourself. So, where you're from, and I believe you're currently in the big smoke of Sydney.
Very glad to be here. Yep. So my name's Andy. I'm originally from Queensland, from Toowoomba, Australia's second biggest inland city. I always love to tell people. And yeah, I've been down here in Sydney for a number of years now, and I run my business out of Sydney.
So Queensland boy. So you must be NRL or league?
Yep. Enjoy watching NRL. Unfortunately for me, I go for the Newcastle Knights, which hasn't been the most profitable investment. But deep down, I'm a true bogan. I adore motorsport. I'm a big fan of anything with two wheels. So I'm a bit of a tragic for MotoGP particularly.
Oh, there you go. We've got that in common. So, look, you've obviously been in the financial advice game for a while. Why and how did you get into financial advice? What's your motivation?
I love listening to podcasts and just looking at different financial planners' websites and the dark hole of humanity that is LinkedIn. And I always love it when people answer this question with, I do this because I just love helping people, or just some, frankly, bullshit tripe like that they wheel out. I come from a family of accountants, so I studied accounting at uni, and I pretty quickly discovered that I had no interest in working as an accountant. And I fell into wealth management as a result of that. I was really lucky and fortunate that I spent most of my career at some pretty decent institutions like Macquarie Private Bank, Wilson HTM as it was then known, which is one of the oldest stockbroking firms in the country. And I feel like that gave me a pretty first-class apprenticeship in financial markets, advice, investments, and that kind of stuff. And I must say that I did fall into the industry by accident, but I absolutely love what I do. I think it's the greatest job I could ever fall into. I love everything about financial markets and investments, and fundamentally, perhaps one of the things I like most about financial advice is that it's frankly not that difficult. If you've got the ability to just look at things objectively, the answers are relatively simple. It's not actually the massively complex or big-brained exercise that perhaps some people represent it to be. It's actually, when you get down to brass tacks, it's quite a simple and logical industry.
Yeah, it's refreshing to hear that from an expert. I certainly know when I got into the fire community, I probably tried to find ways to overcomplicate it myself because I was just like, there's no way it could be this simple. Like when you distill it into a one sentence, it's just live below your means and consistently invest. But anyway, we'll get into that in a little bit. So you started out, you're working for obviously Macquarie Bank, one of the larger investment banks, and then at a stockbroking firm. So how did you make the jump from working for those larger companies to now doing financial advice at a personal level?
My timing was absolutely excellent. So I started my business on 1 July 2021, which for anyone in Sydney was about 4 days after we went into quite a lengthy lockdown, which actually wasn't quite desirable. But as I say, after working what I consider to be really high quality investment houses and institutions like that, you just couldn't help but notice that the truly obscene levels of fees and just the layers and layers of fees, and fundamentally as well, the just hopelessly conflicted position that advisors, the companies that they work for and represent, find themselves in. And for all these purported high octane strategies and cutting edge solutions, etc., that whatever ostensible benefit was given to the client was just thoroughly eroded by fees. And it sounds a little bit self-preachy and high and mighty, but I genuinely believe that it does not have to be like that you really can give people advice without putting your own interests before, and that it's actually not that difficult to give good financial advice. And I thought that genuinely is quite easy to do, but there are many ways to do it a lot better. So yeah, that was the kind of rationale. So I started my business on just in mid-2021 and coming up on 2 years now, and it's been really enjoyable. As you alluded to, I've got some pretty strong opinions on the industry at large, so I do enjoy being able to call out what I perceive to be bullshit quite freely, which obviously is a lot harder to do when you're part of a business.
Yeah, it's interesting, mate. Like, it's refreshing to hear people just saying it how it is. And it must have been difficult, as you say, being in those organizations. Obviously, you have to toe the company line. You're not really allowed to be an individual. I certainly know that from my experience in the workforce. I love being able to have my own voice and do what I want now post-fire. Actually, just want to touch on, so when you started your business, it's not going to be super relevant to everyone, but how do you actually do that? So you go and obviously register a ABN, but like, how do you start a financial advice business? Surely that's like super expensive to do.
It can be. It's like anything. If you're willing to do a good chunk of the work yourself, it's a lot easier. A lot of it's just going through the kind of setting up of an accounting business. Like you say, there are added complexities with financial advice. It's a really intensely regulated industry for good reason. And as you mentioned as well, there is a register of financial advisors. There's only two kinds of people that I'm aware of that are kept on registers, public registers, and one of them happens to be financial planners. But yeah, so it's just a matter of going through. There's a lot of just administrative garbage and back end of financial advice industry that a lot of people wouldn't appreciate. So you've got to be a representative of a Australian Financial Services license, which now I can say that my business, I'm part of the AFSL that I'm part owned with another financial advisor who shares my opinion on the industry. So I like to think that I'm about as independent as you could get, in the sense that my business and our AFSL has no relationship with any bank, any super fund, any insurer. We've got a completely open menu that we can choose from for people, and just as far removed from vested interests as possible.
That's actually a great segue, because the next thing I wanted to ask was, having worked in the industry for over a decade in these prestigious organizations, and now running into your third year of running your own business, what is your opinion on the advice industry at large?
Oh, I could sum it up pretty succinctly. I genuinely think it's just a complete rip-off factory. And that's not just one place or anything. It's just the industry at large, in my opinion at least. And fundamentally, that's just because it's hopelessly conflicted. Like, like, in my personal opinion, I'd say that 99% of the time when someone receives financial advice, it's designed to benefit the advisor more than the client. And it sounds awfully exaggerated, but having done this for quite a long time, that's my genuine opinion. And there's a fantastic line that I just love wheeling out all the time, and it's by Charlie Munger, who's the 99-year-old handman of Warren Buffett, and it's show me the incentive and I'll show you the outcome. And again, like, that's just the root cause, in my humble opinion, that financial advisors, by and large, in the financial services industry and the companies that comprise it, are just hopelessly incentivized to put you in products that will pay them. And again, as I alluded to earlier, the industry is intensely regulated, but all that really does is create just layers of administration just to get to the exact same outcome. You can just look at the outcomes of the Royal Commission, anything before that, and it's not that hard to see that, just at large, financial advice industry really prioritizes their own interests ahead of clients. And unfortunately, just with pouring legalese and financial jargon and terminology, it's not that difficult to just give people paralysis by analysis. Like, it's a bit of a farce, but the Productivity Commission say that there's over 40,000 different options for your super when you factor in all the investment, underlying investments, etc., which it's not that hard to just see as this big, impossible task. So you go and see someone and it sounds and looks great until you actually get under the bonnet and you realise that it's a bit of a fee gouge in many instances.
Yeah, because it doesn't necessarily need to be super complicated, does it? A couple of basic options, a little bit of education about your risk tolerance and time frame for investing, understanding a little bit about the portfolio allocations, diversification. Shit, it's probably a conversation you could have quite succinctly with one of your clients, right?
Oh, definitely. And as I said earlier, the advice industry is intensely regulated. So there is a lot of administration for someone to just say, look, this is what I think you should do when products are involved. And in my opinion, it's created this whole warped industry whereby it's just there for rent-seeking behaviour. And by that, I mean, if it is expensive and time-consuming for someone to tell you where and what to invest in, they're going to try and recoup that cost. And I think my biggest issue with the financial advice industry, if you ask me what's the number one thing that leads to poor outcomes for clients, it's purely and simply ongoing fees. In my business, at least, I'd say it's incredibly rare that I'd ever pitch someone an ongoing fee arrangement, because I think that you can really put a target on it as a root cause of a significant amount of poor outcomes for clients. And the basis being that if your advisor has two options, right, and one of those is a auto managing product that's top tier, it's probably one of the best investment solutions on the planet, but they're not going to get an ongoing fee out of it, or they can put you into some other mysterious lobster pot portfolio of managed funds and they are going to charge you an annual fee out of it. There's a significant economic incentive and personal financial incentive for them to use the latter option and put you in that, which is they're going to charge you an ongoing fee. And a good medical analogy is a lot of advisors are seeking to treat the symptoms and not the cure. If someone's coming to you and saying, tell me how to invest, tell me how to achieve this, save tax, whatever it might be, and again, it's just the whole industry is geared towards this, we'll definitely help you do it, but you're going to have to pay us a monthly retainer. And my philosophy is you should pay for financial advice the same way you pay for advice from an accountant, a doctor, a lawyer, or a plumber. You pay them when you see them. You pay your mechanic a retainer if they're not fixing your car? No. Do you pay a real estate agent a trail commission after they've sold you the house? No. So I think it's a bit ridiculous that kind of the advice industry does really get away with that. And again, there's plenty of explanations as to why. I can't say I've ever heard a compelling one, but again, advisors will make you think that you need to be there seeing them once a month, once a year, whatever. They might try and purport that they've got this magic portfolio of managed funds which is going to outperform everything else, which I just say is completely not the case in my experience. And without sounding arrogant, I consider myself quite reasonably good at what I do. And so if I can't put together a portfolio that's going to be just a top flight industry fund, I think it's quite ridiculous that my peers in the industry think they can.
It's a very interesting observation. I really like something you just said there about do you pay your mechanic a trailing commission after they fix your car? And it's no. But yeah, it's almost feeling like that's the way a lot of things are going these days, isn't it? With the subscription models.
100%. It's everything from cars to Netflix subscription to everything. Like, it is quite literally vehicles. They're going to that. And the reason being, it's quite simple. It's one of the world's greatest business models. Every self-made billionaire typically comes from one of two roads. They design a business that's called SaaS, or software as a service, or they're a hedge fund manager. And the reason being that it's infinitely scalable. If I'm a hedge fund manager or a financial advisor or what have you, and I'm managing $100 million, if I then ratchet that up to $500 million, it's not 5 times the cost. There's no marginal cost of production versus if I'm a pipe manufacturer and I sell 5 times as many pipes. Yes, my accounting costs won't increase and my marketing costs won't increase, but I've got to buy more raw materials. I'm going to use more power. I need more hands on the factory line, that kind of stuff. And again, it's why it's so fabulously lucrative. Because again, if I'm charging ongoing fees, and I would argue that in 9 out of 10 cases, not doing any work, that just means that I can just keep adding more and more revenue streams to this gravy train I've got. I find it entertaining as an independent media outlet that publishes a report every year called The Tax Heroes, saying which listed enterprises get closest to that 30% effective tax rate. And I find it quite amusing because often it's fund managers. And it's not because fund managers are devotees and public interest at heart. I'm not saying they're not, but the reason that they pay an effective tax rate pretty close to the corporate rate is because you can only stuff so many corporate lunches and a circular key office and a few Bloomberg terminals and a $2,000 office chair, and you pretty quickly run out of expenses. It's just more indicative of how lucrative this model is, and it's bloody hard to divorce yourself from it. Like, again, if you do work in the industry, like, it's why people have these fabulous explanations for it all, because there's such a fantastic apple waiting at the end of the road. But yeah, if you just look at it objectively and you just think, is this actually good value for money? My take from it is no, it's not.
Yeah, it's definitely something, even like from the basic principle of saving money or cutting your costs on your path to financial independence. And cutting costs is a big part of it. I'm personally always on the lookout for things that are charging me ongoing fees. And like you said, Netflix, Spotify, maybe some insurances that I don't necessarily need anymore. So when you're not actually getting something, but you're still paying for it, or even if you're getting something, but you're not actually using it frequently enough, it's very easy to just let it sit there in the background and siphon off money. And it's quite funny that you sort of mentioned like the similarities between hedge fund managers and like software as a service. Whilst I don't personally have experience with producing like software as a service, what I've dabbled with is affiliate marketing content websites. And I guess I'm trying to create the opposite there, where it's something that just ticks around in the background and tries to produce a small level of income from advertising revenue. And the funny thing is, what really struck me is when you mentioned that quote from Charlie, show me the incentive and I'll show you the outcome.
The outcome, yeah.
Because even I've had this conflict where as a putting a business owner hat on, okay, with some of the websites, I just want to get the most advertising revenue. Whereas when I look at passion project sites like Captain Fire, I'm constantly getting bombarded with requests to put like Forex ads or like CFDs. And so I don't really want to put that shit to vandalize my website because what is it, like 80% of people lose money trading CFDs. So there's always a huge ethical trade-off when it comes to these kind of things.
Exactly. And there's only one ethical Forex that you should advertise on your website, and that's, of course, the beer Forex, the full flavoured Australian lager, Forex Gold.
Being from Queensland, you're pretty familiar with a few mangoes.
Exactly.
Castlemaine Cranberry.
Greatest country on earth, Queensland. Yeah.
That's another thing about websites is that pretty much anyone with a laptop or a PC, even you can do it on your phone these days, can throw up a website and can be publishing. Not necessarily correct information either.
Definitely. But again, it just goes back to that point earlier. So, for instance, you can have a roster of 100 clients on your book or higher in some cases, and they pay you a fee. And all you do is leave them in a portfolio managed funds that rarely, if ever, changes. It's an amazingly lucrative business. And it's pretty hard to turn that down. When you're going through the industry, there's a lot of money to be made. And often you don't have to do a lot of work for it, not in my opinion anyway. It is a really difficult thing to divorce yourself from, just that whole, personal financial gain. But yeah, the positive is for every problem with the industry, there are some simple, incredibly easy ways to go about riding the ship and just setting yourself up really well.
So how did you divorce yourself from it then? Because it feels like you're giving away the secret sauce here, and it sounds like you could be making a shitload more money if you just start charging trailing commissions. So why do you just give upfront fee for service?
Oh, I don't want to pretend I'm Jesus of Nazareth or anything like that, but it's just being completely honest. I just get no satisfaction from if you see a client, and let's just say using the old rule of thumb now, I don't charge percentage-based fees, but it's fairly standard in the industry. So if someone has, say, for instance, $500,000 or $1 million investments, a pretty standard fee would be 1% for the management of that. And quite frankly, I just get no satisfaction from using $1 million client, for instance. That means they're paying you $10,000 a year. And again, if they're just sitting in a managed account or a simple portfolio of stocks and managed funds that rarely if ever changes, I just genuinely get no satisfaction from sitting in front of that person at the end of the year and saying, hey, by the way, we did this and we probably underperformed the better super funds out there and you paid us 10 grand and we're just going to do the same thing for the next year and the year after that and the year after that. And maybe there's some tinkering around the edges. But the other thing is that often when you first see an advisor, in many cases, they can add a lot of value. You might have your super all over the place. It might not be structured correctly. Just sorting it out at the beginning can actually really help people. And again, that's just going through, are you invested appropriately for your age and your distance to retirement and just personal preferences? Are we saving tax in the right fashions? Are we planning for the future in the right fashions? Are we establishing when and how and you're going to retire and that kind of stuff? All of the stuff at the start is generally really good. It's just almost always people go into the wrong product because, again, it's just paying that ongoing fee. So, again, I thought the first bit's fine and the rest of it's a bit of a raw. I'd rather just have a crack at doing it properly with client interests at heart rather than just continuing the status quo.
Yeah, that's really positive, man. It's good to hear. And I think it'll probably resonate with a lot of people in the FIRE community, because I like to think probably are savvy consumers, and that sounds like the way it should be. So obviously you've talked a little bit about super and how setting it up correctly is important. It's probably something that doesn't get as much attention as it deserves in the FIRE community because where our timeframe's probably a bit shorter than your typical Australian planning for a 65-year-old retirement. So what is so special about super and why should people on the path to FIRE still be paying attention to it?
So I think that superannuation is just the greatest wealth creation tool on the planet. There is nothing else like it, genuinely. And that's for two reasons. A, the actual superannuation as a tax structure. And to put it succinctly, it's a tax dodge on the way in. It pays next to no tax while it's in there, and it's tax-free on the way out. Now, the caveat for that, naturally, is that you and I can't access it until we're 60 years old, which particularly for people like your listeners in the FIRE orientation and FIRE community can be a bit of an issue. But fortuitously, there's been some law changes, namely the treatment, just generally speaking, around concessional contributions, which can make it a lot more useful for people on that FIRE path, in my opinion, anyway. It can really work well. But the other fundamental thing that just makes super totally on its own is, generally speaking, industry funds. So again, that's something else that you're hard-pressed to find a single example of anything that even compares to it globally. And fundamentally, the thing that I always say to people is that there is no one perfect fund. And anyone that sits in front of you and purports that there is either stupid or lying, or perhaps even both. But whilst there is no one perfect fund, you can pretty quickly narrow it down to the good ones, average ones, the crap ones, and the great ones. And again, there's not one great fund. There's probably half a dozen or so. And all it really boils down to is the fund that you're giving it to going to get you a really high return for a really low fee, and are they going to be able to continue to do that for the next 10, 20, 30 years? There's a million things that you can unpack with respect to that. But fundamentally, when you just look at the net returns from funds, industry funds are generally at the top of the pops. And what's often not very well discussed is the fact that whenever you see a fund return, it's net of taxes and it's net of fees. So all the time I see these products getting whirled around or what have you, and might be for a single investment or someone's claimed managed portfolio or some garbage like that. And they'll purport to have this return, but A, it's not net of tax. B, it's not net of advisor fees. C, it's not net of administration costs that will typically be associated as well. So it's always important that you're comparing apples with apples in that regard. And again, going back to it, like if I recommend someone go into an industry fund, I'm not going to charge them any ongoing fees because I'm not actually managing the money. And B, there's no economic interest for me to do that. So astoundingly, I'd say the lion's share of the advice industry doesn't really have any interest in doing that because there's nothing in it for them. But again, when you just look at returns and the way that they manage the money, it's second to none. I did write a pretty critical article about one of the industry funds and met with the CIO after, and he just had this, and it completely changed my opinion on the fund after that. But he just had this great line. He said, we let anyone invest like a billionaire. And quite frankly, that's what it does. If you do put your funds in what I consider to be a top flight industry fund, you can genuinely rest assured that your money is managed as well as any billionaire on the planet. You are getting the level of service and sophistication that someone like Mohammed bin Salman or Bill Gates or Mike Cannon-Brookes or anyone like that, you are really in the best of the best. And again, it comes back to one of the most just important tenets is that for all intents and purposes, they are independent. They're not owned by a bank, they're owned by the members. And so because of that, if they want to invest your money, they don't just default to using a subsidiary to manage the bond portfolio because that's good news for shareholders. They'll go out and find the best of the best to do it, or they'll do it in-house at a really low cost. And something that I always find very interesting is that the notion that your local advisor, or even let's just say that they work for a big multinational in the CBD of the state capital, the notion that they're going to get a better investment than, say, a $150 billion fund is just a joke. Buying investments is no different to buying fruit. If you buy in wholesale, you get better prices. But in addition to that as well, you just get tickets to different leagues if you're in the large funds. If you are the world's greatest currency trader or you are the world's greatest private equity manager or hedge fund manager or whatever, if I had, say, 100 or 150 clients and we pool 10% of all their money, go to Mr. Manager and say, hi, Mr. Man, would you please, or Mrs. Woman, would you please manage our $15 million? They'd say, no, thank you, go away. But if you're a $150 billion industry fund and you go to them and say, would like to allocate you $500 million or whatever the number might be, they will happily take it. And the benefit as well being that because for all intents and purposes, they're independent, if that manager doesn't perform, they'll sack them. If the fund can figure out that they can do it in-house, much reduced costs, they'll do it. But equally for the ones, because there are really fabulous investment managers out there that are worth their fees. The problem is that by the time it gets to an average person, it's just gone through so many layers that you're not getting the best product. And there's also just so many palms to grease along the way that any benefit that you would have got from their outperformance has just been eroded by a fee. And again, the Productivity Commission did a really good investigation into super years ago. And at the time of writing, there was 40,000 different superannuation options. And again, a lot of those are underlying investments, but it's just crazy. And again, it sounds simple, but if you just go and get someone who's going to do it for you, and if that person is a big industry fund that's not incentivized to pay shareholders, put it in a bank manager, you'll get better results and you'll save yourself a huge amount of money over the longer term.
You said it before, I'll say it again. Show me the incentive, I'll show you the outcome.
Yeah. Every time.
Yeah.
And it's common, the advice industry is by and large pretty motivated to poo that idea. And some people might just say, oh, he's an idiot, he doesn't know what he's talking about, whatever. But my social life is riotous enough that I've actually gone through. So with a lot of funds, I'll tell you who manages the money at the end of the annual report. So they'll have a list of the managers. And one fund in particular, Sun Super, which is now Australian Retirement Trust, they go a step further and they actually publish their investment portfolio on their website. For instance, in their balanced option, you can go through and you can see every manager and every investment that they hold. And typically, when a financial advisor puts in a portfolio, they'll do it via something that's called a wrap product, which is just an investment account. So they'll put you in that wrap and then they'll go and select a bunch of managed funds. And again, so what I thought was, let's just have a look. And this is just taking Sun Super, whenever it was, probably in 2021, I think I did this. And I went through and I found the most expansive wrap menu. So the investment product that had the biggest menu to choose from, I think it was either 800 or something different funds that you could choose from. And then I compared that to Sun Super. And I thought, all right, let's be fair. So often you'll see in an industry fund, any fund for that matter, they might have someone like Goldman Sachs or Macquarie or Morgan Stanley or any number of managers that will also appear in the wrap product, and yet they're doing it for an industry fund as well. And so it's important to note that you're not going to get the same price if you're just a itsy-bitsy individual when you compared to a $100 billion gorilla. Like, they're going to beat down the manager's costs. But anyway, just in the interest, I thought, okay, so any manager that appears in the wrap menu and the Sun Super portfolio, I'll just remove them. And of the 69 investment managers that Sun Super had, 61% of them, you couldn't find the manager, not just the fund and the value for money, but you could not find the manager on what I found to be the broadest wrap portfolio. So again, that's all these incredibly big hitting US, Japanese, European, Australian managers that you can't even access through an advisor, because again, they're just absolute gorillas, just Goliaths that have no interest in managing small fries money. They just want to go direct to the big funds. And again, the reason that they're employed is because they do something really well. They might be exceptionally good at managing a bond portfolio. They might be exceptionally good at managing a property portfolio. And there's, hypothetically, at least with industry funds, there's no corporate interest there. They're not just defaulting to, oh, this is a subsidiary of the bank or this is a related party, so we'll give them that allocation. It's you either perform and you maintain your mandate or you get sacked. And secondly, if the fund can figure out that they can do it in-house, which is a serious trend going on, and it's brilliant. A lot of funds are now managing up to sometimes more than half of the money in-house, which really brings down costs. Again, so for anyone that says, oh, it's just a rubbish investment product, I say, all right, well, prove it to me, because you and I can't go and access 61% of the managers. And then of that 39% that we can access, I'll bet you my left hand that we're paying a higher fee than a $150 billion fund can negotiate, because they've got just a significantly higher bargaining power. So, yeah, so for anyone that just defaults to poo-pooing, oh, no, their products are rubbish, when you actually look into it and you do a bit of research, you find that it's quite the contrary, that they're actually, and that's where I go back to that earlier point. It just helps everyone invest like a billionaire. And again, there's plenty of examples of retirement tax structures globally, here and abroad, that are pretty comparable with super, but it's that industry fund model, which is you really don't find it anywhere else. And it's pretty goddamn simple. It's just these funds are owned by the members, and by virtue of that, they tend to historically get a lot better results for their members because they're incentivized to do so.
So knowing that, how do people go about actually starting to choose a fund? So what are some of the different factors that might make a fund appropriate for certain people?
Great question. And again, there is no one perfect fund. So going back to that example, if I look at what I consider to be a first-class A-plus fund, the notion that I could say with conviction that this fund is better than that fund, when again, we're talking about maybe 70, maybe 100 different underlying managers, just thousands of separate investments. It's ridiculous. But what you can do is this. So first and foremost, you want to make sure it's a low fee or a good fee. You want to make sure that you're getting value for money. Something that I just think personally that the FIRE community is often just a little bit over-focused on is the lowest fee. You don't necessarily want the lowest fee. You just want to get really good value, right? If you're getting a Ferrari at the price of a Toyota Corolla, it's a good deal. It's probably worth buying. But again, so what might make you figure out what fund is best for you is how old you are. Some funds are better at dealing with retirees. They've got more comprehensive strategies in place to make sure that retirees are getting the absolute tax-free earnings that they're entitled to. It can depend on how big your balance is in often cases, and that sounds like it's a bit of a dodgy argument, but also how big your partner's balance is. And the reason for that is it's not all that uncommon that I get clients with pretty substantial amounts of money in super. And what I'll often say is, look, this is what I consider to be the absolute two best funds. And say, for instance, you're only allowed to have 1.7 million in your pension in your retirement account, which theoretically should increase to 1.9 in 1 July. But if you've got a significant amount of money outside of super, in addition to that, what I always say is, if it's not going to make a difference to the fees, why don't we choose two funds? If you had a race, for instance, and you could back one horse, why not back two if it's not going to cost you anything? And often what you find, there's funds that are complementary to each other as well. One fund might, for instance, do a lot of investing in unlisted assets, infrastructure, property, private equity, private credit, etc. And then you might have another fund that doesn't do a lot of that. And again, it's not one or the other, but if you're fortunate enough to combine the two, it's fabulous. And again, that ties into often where's your partner's super, if you have one. In addition to that, there's just some pretty simple ones. Do you need insurance? Some funds have cheaper insurances than others. That's a pretty motivating factor. There's a lot of industry considerations as well. If you work in particular industries, for example, the military, public service, construction, some funds might appeal to you more. They might invest in projects that theoretically you stimulate your industry. I'd argue that's actually the complete reverse way to go about it. If you've got your retirement savings, the less correlated they are to your earning, the better. If you work in the mines, if you hang yourself out to dry, if all you do is own mining stocks because you're too exposed to one thing. But for a lot of people, a really important thing. Another thing is whether your employer has negotiated a good deal. Like occasionally you'll find that a retail fund, which I consider garbage, but your employer might have negotiated a really good deal. So it actually turns out to be a really good option. So there's a consideration there. Insurance is often the dictating factor there as well. If you do have really good insurers because you work for a business that's negotiated that, often keeping that account open is a real priority. And then the other most common one, which I just see so much advertising for and I find it so intriguing, is the more personal trait. The obvious example being ethical investing, which is a real focus for a lot of people. And often that can be a dictator. And that's a pretty deep pool. When you actually drill into it, there are some pretty big discrepancies between the funds. And for some people, it might be a gender equality thematic to it as well, or a faith-based or religious-based preference. But more often than not, it's environmental. And again, there's different levels to attack that problem. For instance, some funds might not purport to be. There are a couple of funds out there that advertise as being focused on gender equality, females in particular. And I would argue that why wouldn't you just select one of the better industry funds that does the same thing? And the way that they do that is that they're quite rigorous in interrogating the actual underlying managers of their mandates they give out about their own. How many females do you have in your firm and at what positions are they and that kind of stuff. And they really have a deep prerogative to advance that. And in their own C-suite and management and executive team, what's the gender diversity like? And similarly with the environmental and SRI, ESG, environmental, social and governance, and then SRI, socially responsible investing. When you actually drill into what underpins that, it can do a lot of interest. I could talk for an hour just on that. And also fundamentally, what's your own preference? Do you want a fund that invests in that's headquartered in your state, like you're really parochial about that? Is that a major focus for you? Or again, do you like the colour of one? It's not even a joke. If there's three funds and they're all top flight and they're all within half a centimetre of each other, again, you're not going to do yourself a disservice. One of the things that I really do focus on, particularly with the funds, is size. And the reason for that's pretty simple. Size matters. And the regulator's been pretty active in saying for years and years, the Nurses Union in Queensland had their own super fund, the Nurses Union in Victoria had one, the electricians in WA had one. And the reality, if you're an electrician in Western Australia or an electrician in South Australia, your superannuation needs are not any different whatsoever. So there's a lot of consolidation in the super space, and it's fantastic. But one of the things that I always run an eye over is the smaller the fund, the more likely it is to be swallowed up by one of the others, one of the big ones. And again, I do think that you can say that some certain funds are slightly better than others. So I do try to make sure that I'm not going to recommend this fund, which in 8 months' time is going to get swallowed up by a fund that I'd give a grade of an A- when I could have just gone to an A+ to begin with. So yeah, it really is horses for courses, but fundamentally it just comes down to I'd say the two biggest dictating factors are insurance and what stage of life you're in. Because again, some are really good for young people, but they might not be as cutting edge when it comes to retirees. And again, particularly with insurance.
Yeah, there's a lot to think about when you're actually going to select a fund. I mean, everyone talks, obviously, Barefoot spoke a lot about the Host Plus, and I actually had a Host Plus account. And funnily enough, as a pilot, I couldn't get insurance through Host Plus because it's one of the exclusions. So it's super important to go through all of those criteria, because you hear all these stories about people, just specifically with the Host Plus example, that have switched to Host Plus and have lost their TPD, income protection insurance.
And naturally, whether they're a good or bad fund, no one will ever really warn you on that. Unfortunately, it falls under the kind of personal accountability, and most people aren't aware of it. And but also within these top flight funds, it's just once you explain to someone, look, this is the kind of tilt that these funds have. They might manage money in a slightly different fashion. Like they might do nothing internally and they just give everything to the best of the best. And that's why their fees are slightly higher than another fund. Or for instance, one fund might steer clear of unlisted assets altogether. And again, it just depends on personal circumstance. But again, it's not that hard. Like you can just look at what the top 10 are over a 5, 7, 10-year basis. And there's a lot of similar names in there. It's not all that difficult, but equally, if you do want to understand why the particular fund that you've selected is the best for you, it can help. And again, what I always say to people as well, I think school grades is also a really good way to communicate like ratings for funds. Like just because a fund, I give it an A plus and another fund an A minus, just because of slight peculiarities about what they do or how they go about it, doesn't mean that the A plus will outperform. They're all really good products, and it's not the case. It's not a zero-sum game. It's not, I picked the wrong one and now I'm destitute. It's more just the case you might find that one just slightly outperforms on a 10-year, but equally you got a great return as well. So it's also, I don't want to create the impression that, if you don't pick the right one, your life's over, you're begging in the street in your 70s. It's not the case at all. And again, it remains to be seen how a lot of these funds will adjust to being bigger and bigger. Part of what makes industry funds so good is that they've been around for 30, 40 odd years. And so during that time, they've built some phenomenal infrastructure and processes and people and staff and strategies and all the rest. But it'll be interesting to see how some of these funds, managing $60 billion is no mean feat, but when you look at just the wall of money that goes into super, it'd be interesting to see how some of them acclimatise and adjust to managing $500 billion, which a lot of them will theoretically get to, particularly with the regulator saying we want to see less funds, i.e. more consolidate. So that'll be quite interesting. I think that's something to watch over the next 10 or 15 years, is how these funds adjust from being big to really big, because I think some are better prepared than others.
Yeah, it'll have an interesting impact on the fees, because my understanding is that the larger the fund, theoretically, they should be able to get better deals. And it's the same, you mentioned it before, you're basically wholesaling, you're buying in bulk. And fees, they're pretty important. So I want to quickly read something out from one of my favorite blogs that I like to read, and that's Eli's blog, Passive Investing Australia. So he wrote an article which was called How 1% Fees Cost You a Third of Your Nest Egg. I'm sure you would have read it, but I just want to read out a little excerpt from the article. So Eli mentioned an annual fee of 1% of your total assets is really 10% of your annual return. Due to inflation, a 1% asset-based fee is over 16% of your average annual portfolio gains in real terms, i.e. real purchasing power. Lost earnings from these fees compound to vast amounts over time, much more than the actual amount paid. The result is that a 1% higher fee results in a loss of about 1/3 of your super balance. The 1% asset-based fee reduction in retirement reduces your 4% drawdown rate to a 3% drawdown rate in terms of actual ability to spend. So once you combine the reduction of 1/3 of your nest egg at the end of your accumulation, as well as the loss of 1/4 of your income generated from that shrunken nest egg, your retirement income has fallen by half. That's pretty crazy, man. To me, that sounds like fees play a huge part in how you would select a fund. So from your opinion, as a qualified financial advisor, you do this every day. How important are fees, and how can you make sure that you're getting good value?
Fees are crucial. So technically the most important thing, the biggest dictator of your return is how the money's invested. If you sit in cash versus a high growth. But as you can tell on my views on things, fees are just unbelievably important. And again, it's one of the symptoms of just advice as a whole. The amount of jargon and layers are astonishing. So fees are super duper important. And again, it's not about the lowest fee. Just because one fund might charge you 0.5% and the other fund charges you 0.6% doesn't mean that the 0.5% fund is immediately going to do 0.1% better. But again, you have to be in that good value window, which again, I'd say most of the top performing funds 100% are. And not more just important than, I'd say more important than just the fee of your fund or your investment or whatever is what other fees are you getting stripped out. So again, if you go and see an advisor and they put you in a portfolio of managed funds, which I'd argue are probably pretty mundane and not going to do a great job. It's not just the cost of those funds, which again, let's just reiterate, if you're a $200 billion fund, you're getting cheaper fees than just any person off the street. But secondly, you're going to have to pay an administration fee to access those funds via what's called a wrap or an investment product or something of that nature, or a retail super fund, whatever it might be. You're going to more than likely pay advisor fees, which again, I'd argue at the start, you might get some benefit from, but going forward, I struggle to imagine how they're justifying the costs. You might be paying other fees as well, statement of advice fee, implementation fee, brokerage fee. There's new ones being invented every day. It's aggravating to say the least. Yeah, so fees are crucial, 100%. And again, in every financial product gives you what's called a product disclosure statement, and the regulator, which is like the terms and conditions on your iPhone, I dare you to read it. It's incredibly boring, but there's a big box that's in every single one. It's from the regulator, and it says a 1% difference in fees can make a X%. I believe it's a 20% difference to your end balance, because that's the thing. 1% doesn't sound big, but small percentages make incredible differences in dollars. And again, it's why the advice industry as a whole really likes charging clients percentage-based fees. It's twofold. A, it's an infinitely scalable model. It's extremely attractive from that perspective. But it's also, if you say to someone who's got $2 million or $500,000 or even $250,000, hey, you're going to pay us 1%, we're going to manage your money. You think, oh, okay, yeah, that's all right, that's fair. But if they actually said to you, by the way, we're going to take $2,500 from you, or you're going to pay us $10,000 a year, or you're going to pay us $20,000 a year, people recognize that more. And that's why the regulator requires in a statement of advice that you actually display the dollar fee that's being charged. Same with product disclosure statements. They don't just show you the percentage-based fee, they'll tell you the actual dollar fee being charged. And again, you can just go on forever about fees, but even within your fund, there's different kinds. So even a top industry fund, there's typically two. One is an admin fee, totally fair. They've got to have call centers, they've got to have email, they've got to have a working website, they've got to get audits, all that kind of stuff. And then there'll be an investment management fee as well. And again, it's that case that 100% the lower, you want low fees, not necessarily the lowest, because there's some truly horrific products out there that don't claim to charge incredibly low fees, like genuinely, and they're just dismal. But equally, if you can get in that good value, it's money that's actually going to continue to be invested, not just ripped out. And again, there's 40,000 different options, right? And there's, 130 odd MySuper registered funds or something like that. So the discrepancy is huge. And it's not just the fee of your fund, it's also what else are you getting done for? Are you paying advice fees, which you're getting zero value for? Are you paying admin costs because that product benefits the advisor, not you? Are you paying more than you should because you're buying your groceries from, say, the 7-Eleven as opposed to going to the wholesaler direct, I suppose would be an analogy. So, yeah, fees are just very crucial.
Yeah, and look, I also just want to point out as well, because I've read that standard line, a 1% fees results in like a 20% lower balance. And I was like, huh? I think it's important to just denote the time frame as well. So I've got Eli's website up here and I'm looking at the graph he's done for his modeling. And yeah, that 20% reduction, I think that is around around 25 year mark, whereas the modeling that he's done is, I guess, more on a more realistic career of 40 years, being that you start the workforce somewhere between 20 and 25 and you retire at 65. So there's your 40-year working career.
Further to that as well, what you generally tend to find is, again, using that analogy, if one top performing fund is charging, say, 0.55% for their balanced option and another fund is charging 0.77% for their balanced option, that's okay, that's fine. They'll probably go about it in slightly different ways. One fund might internalize more, or one fund might use more costly investment strategies, which theoretically are better. But again, it's when there's big disparities. If you're paying north of 2% for a fund, my question would be, why? In what universe is that going to benefit you? And yeah, it's not hard to get a low cost fund. And as you say, it's over time, because superannuation is, for most people, the biggest asset outside the family home. And again, it's in there for a long time. So the earlier you catch it, the less the effect. And another thing as well on the fee discussion that can really savage people's balances is insurance costs. I did actually bring some new laws in to protect people around that. But typically what you tend to find is, often if people have 3 or 4 funds, just by virtue of you signed up, you joined a new employer, which is a pretty common thing to do, they might have 3 or 4 different funds that are all paying different insurance costs. They're all doubling up on that administration fee cost. And again, maybe some of them are good and some of them are just pure rubbish. Because again, the thing that someone said to me once, which I thought was great, because I've stolen it, is, would you let your employer choose your house or your car or what bank you're with? Because ostensibly that's what you're doing with your super. And I'm not inferring that they get an interest for it, but it's more that there's a whole sales channel in financial services, which is called corporate super, where basically funds go around to employers and say, we want to be the default fund for your company, and here's why we think we should. And some of those funds are probably really good funds, and I guarantee you some of them are shit out.
The takeaway there is that they're not tailored for your personal situation. You fairly comprehensively listed a huge number of factors that people need to consider for their personal circumstance when they go about choosing a fund that you'd sit down and talk to them through. But if you're just jumping onto a default bandwagon, you're basically missing that whole process.
Oh, 100%. And again, there's a really high chance that you're already in one of what I consider to be the top performing funds, which is fine. But again, your HR professionals or your people and culture professionals, whatever you want to call them, they're not qualified financial advisors. They don't pretend to be. So if you've got a really good salesperson that's representing a really rubbish fund, well, maybe they'll get through and they'll get the default option. And again, that's less of a problem now than it used to be, just because there's been a few changes to the way that workplaces and super funds interact. Namely, there's less default insurances, which savage people's balances over the long term. And that was one of the key things that the Productivity Commission found. That was a real handbrake on people's retirement balances, but also your super's more likely to follow you now rather than just, I started a new employer. Because the whole thing is, right, if you're in your 20s, 30s, or even 40s, it's just out of sight, out of mind. A pretty regular reason for people to get advice from me is they come and see me and they've got 3 or 4 funds, and maybe 2 of them are brilliant, 2 of them are garbage, and you just basically, consolidating is a pretty rational first step.
So you said something a moment ago which kind of made my eyeballs pop out of my head a little bit. We were talking about fees, and the number you mentioned, you were talking about comparing 2 funds, one with 0.55% fees, one with 0.4%. Or those, to me, they sound like bloody high numbers still, because when we talk about outside of super investing in the brokerage platforms, we've just seen a few of the players in Australian shares like dramatically drop the management expense ratios, which is making index investing just even more cheap than it was before. I guess the question is, active versus passive, why should it be different in super, and why are the fees so much higher when you're investing in super compared to just in your brokerage account?
100%. Australians pay $30 billion in super fees alone every year, and I'm not 100% sure whether that includes advisor fees. I suspect it doesn't. But yeah, so it's a massive industry. Look, this is where I suppose I differ a little bit from the standard FIRE playbook. And again, I think it's hilarious how on the money 99% of the stuff that self-directed people in the FIRE camp just get bang on. But I always say to people, and this is just my personal opinion, passive investing is the second best way you can ever invest your money. You're never going to turn around and be rue the day that you utilized a low-cost index-based approach. It's just not going to happen. and it's a really good way to manage money. But again, this is where superannuation is different. Going back to that earlier point, it's not just the fact that it's a really good tax haven. Again, it's some of the participants in it are owned by the members. And I challenge you to find another mutual society that there's one really big one that I suppose most people would be aware of. But apart from that, like there's not many left. And yet you have a bunch of them in super. And again, what do you tend to find with mutual loans? Like they represent member interests better. But again, what makes super different is, well, a few things really. For instance, if you just invest in a bog standard, high growth, index-based, passive, whatever approach, you're going to invest in different things to say a high growth investment option in a top performing super fund. And what do I mean by that? So like industry funds or just a consortium of them at large own, I believe they own every single international airport in the country, or at least a share of which, excluding Canberra, which is privately owned. And again, so that's one of those cases where every time a plane lands, you get paid. Same with all the ports they own. Every time a ship docks, you get paid. And if you're in a passive investment, you don't get exposure to those kinds of investments. Same thing being with property. You'll find that good super funds own reams and reams of property, and that's everything from pubs to medical centres to often very attractive buildings that are tenanted by government tenants. It might be someone like the ATO or a state government or something like that. And then another one that's coming more and more into the fore is private credit, which is, again, unlisted. And again, if you just stick to a passive approach, I don't think you can turn around and be depressed or disadvantaged or anything like that. I think you'll do fine. But again, that's what makes super different. There's nowhere else on the planet that you can go and give someone $1,000, $10,000, $5 million and get a ready-made product of cutting-edge investment managers that are all selected independently. And again, a lot of that's done in-house. So what you tend to find is any good super fund, take for example the S&P 500, it's pretty goddamn hard to add value after you're managing an investment like that, because again, it's quite an efficient market and it's so followed. But compare that to, say, someone like Japan, where managers can often actually add a bit of value because, again, they've got some really interesting things just with corporate governance in Japan, which makes it quite an interesting place to invest. Same thing with China. It can pay to have someone actually running a ruler over that and trying to find the better investments, because again, it does come with its own peculiarities investing there, because just the nature of the communist government and that kind of stuff. But again, what it goes back to is, if in order to get that person who's trying to pick the winners and dodge the losers, you pay advisor fees, admin fees, layers of fund fees, and then at the same time, the end product you get, you're paying double because you're retail, you're not going through the wholesale channels. Are you going to get any benefit? Absolutely not. It's just going to get eroded and you're going to get a less than market return. However, if the only person in between you and that superstar bond manager, hedge fund manager, property manager, whatever it might be, is your super fund, that's it, and your super fund is charging you an admin fee of $78 a year, you're probably going to see a bit of advantage there. And again, if that particular manager didn't perform, well, they're not owned by the super fund. They'll get sacked and someone else will do it, or they'll just move it to passive. So again, what you tend to find is that most of these good, it's like anything in life. It's not one or the other. But again, that's part of the things that I discuss with people, because some people come with that mindset. They're like, I'm all about the index approach. It's the way I understand. I love everything about it. And I say, that's fine. Here's what I think the better ones of the index products are, because that's actually pretty interesting. Actually, we could talk for a while about that. Some of the index super products are pretty nauseating, but equally there's really good ones as well. And I also think, and this is particularly of interest for the FIRE community, is that it's no secret that, again, because I consider super standalone there, outside of super, I struggle to find a more attractive way to invest money than just putting it in a simple index ETF. It's low fee, it's low tax, it's low turnover, it's brilliant. And again, going back, it's like anything in life, it's not one or the other. So what I tend to find is that, particularly because I get heaps of FIRE people come across, if you do have a significant amount of money in passive investments or index investments outside of super, well, maybe it's a really good diversification that you get a super fund that does do quite a bit of active management. Because again, you might be investing in things that you're otherwise not exposed to, be they airports, property, private credit, long short strategies, whatever it is. You might be getting access to that that's really complementary. But again, it depends on the person. Some people just don't want to borrow that, and that's totally fine. But when I look at it anecdotally, I just think it's a perfect combination. And again, if under that 0.75 balance fee or something like that is quite literally some of the greatest minds in investing who time and time again really deliver value, that's fine. If underneath that 1% management fee is a bunch of low-grade third-tier managers that are affiliated with the bank or financial services business that runs that, so get rid of it. So again, it depends what you're paying for. And again, I just find it entertaining. I was listening to a podcast, and it was one of the business ones, and it had the chief investment officer or what have you for a big American firm that have a really large advice business here, and he was just waxing lyrical, saying, and they do a big investment consulting business as well. Like, it's just amazing how ahead of the curve Aussies are with respect to super, in that they are in a lot of these alternative assets. And I found it quite amusing because he was shooting himself in the foot because his actual advice business would try and steer people clear of that. But outside of that as well, it's a bit ridiculous to say, but over the next 30 years or so, I think like the investment climate will change. Like you're seeing a lot more businesses getting taken private off the ASX at least. And as a result of that, if you're just wholly in a passive exposure, you might miss out on certain investments. But again, it really depends on the person, or fundamentally it depends on the product.
So just exploring some of those alternative investments. So you've mentioned things like airports, and I'm aware like there are different investment groups that have things like tollways,
Yeah.
and other like infrastructure. And that was an option when I was going through like Host Plus, was do you invest in the infrastructure? I forget the name of the fund, but I'm pretty sure it was just called Australian Infrastructure. Can you tell us a little bit more about these unlisted assets and the role they fill in super?
It's a bit of a personal gripe of mine, which is a fairly long list, let's be honest. But one of the most common things that advisors will say is that anyone who's got a vested interest is that XYZ fund, they're full of shit. They're just cooking the books on the returns of their unlisted assets. Because if you and I own, for instance, Sydney Airport's a perfect example, and it's traded on the ASX, there can be no argument as to what it's worth. It's worth $6.50 a share or whatever it traded at as at close. Where it gets more nuanced is once that thing's taken private, it's up to the fund to determine what it's worth. And again, there's very stringent processes in place. It's almost always done by accounting firms, ideally one of the big four, and they'll have a methodology, whether it's comparing like for multiples of the profit it made a year, whatever it might be. But again, where it gets interesting, and there's two quick things I want to unpack there. But first of all, and again, it's a common thing you'll hear from advisors that'll say, oh, no, they're rubbish. They're just imagining the cost of Port of Melbourne or something. And then the exact same advisor will go and put a portion of your money in something like a private credit fund or unlisted infrastructure fund or an unlisted property fund. There's some advisors quite active in the media, and I just find it hilarious. They're always talking about, oh, this is the commercial property trust that we're doing, and this is all the yield on the properties, etc. And again, it goes back to that point. Okay, do I want to invest in a property portfolio that's going through my advisor, through an admin fee, that's cut up into little retail portions, and then finally goes to the manager? Or do I just want to go direct through my $150 billion super fund? I'll take the latter example for me personally. So first of all, I would just always take that with a grain of salt because it's just a common BS line wheeled out by the industry. But the other more kind of interesting thing with regards to these unlisted assets is, again, a lot of these funds are $50, $60 billion. Some are up to $200 billion plus. And once you get to those sizes, it can get more difficult to manage money, and it's a uniquely Australian problem. So the ASX as a whole, like Australia is a nation of houses and holes, and the ASX reflects that. A lot of banks which are exposed to property and that kind of stuff, and a lot of miners. There's some fantastic quality miners on the ASX. But outside of that, I think it's 2% of stocks globally or something. It's a minnow on the world stage. And one of the problems that super funds have is that they've just got this wall of money coming in. For some funds, it's $1 billion a month. For some, it's more. And they've got to put that cash somewhere. And for instance, one of the things is if you're a Australian super fund, all of your members want to get paid in Aussie dollars, and their retirement needs are going to be in Aussie dollars. So you might think, oh, that's fine. I'll just go invest in the States where it's really easy to do that. But then you're just taking on loads of currency risk. Essentially, you've got this issue where they do want to keep a big foot in Australia. You want about 20 or 30% of your money. It depends on what risk profile you fall into in Aussie stocks. But unfortunately, as I alluded to earlier, there's fantastic miners on the ASX. There's really high yielding banks. I wouldn't go accusing them of being fabulous businesses. And there's a handful of other companies. Once you go down the list, when you get to the 200th company, like the market cap isn't that big. So they're in a bit of a bind because they've got all this money and they need to put it to work. But equally, you've really got no choice but to be really heavy on the top 50, top 100. So again, that's what I was talking about earlier. Some of these funds are better prepared for the next 20 years or so because, it's the exact same thing with the 1% of fee. It takes a long time to get from $1 billion to $6 billion. But as you're growing every year, that gets bigger. It's like a hockey stick graph, like the growth gets bigger and bigger. And again, so a lot of funds do like the element of these unlisted assets because, again, you are seeing certain businesses and particularly infrastructure getting taken private off the bourse, off the stock exchange. And a lot of that was a function of the low interest rate world, which some people argue is done and some people argue we're going back to. But again, a big part of that was that because you're getting less than 1 or 2% on your government bonds and you need reliable cash generating assets. So you're happy to buy a toll road or a bridge or an airport or an office block or whatever it might be, because again, it's a strong, reliable income. So there's a good argument if interest rates stay where they are, which plenty of intelligent people say they will, and plenty of intelligent people say they I couldn't imagine that they will for a long time, but that it's less of a focus now. But going forward, if you can, particularly for these big funds, keep a foot in the Australian dollar, and you can do it by virtue of holding these big assets which you can pour money into. You can also load them up with debt, which can really enhance the return. But I think a lot of it's a function of just keeping exposure in Australian dollars. A lot of it's a function of trying to diversify more and more. Stocks are more volatile, and fundamentally as well, it's just preparing for being that 200, 500 billion. And you see some funds are really beefing out their internal capacity to do that. So they're opening offices in London, New York, Zurich, you name it. And the basis being they're trying to get ready for when that comes. So they don't have to go and pay some rather expensive manager. Macquarie is one of the biggest infrastructure managers on the planet when they can just do it themselves in-house. And it's one other silver bullet the industry funds have. Got a business called IFM Investors, which is just a consortium of funds. I think there's about 10 or 13 of them, which are all industry funds. And again, it's of the same design as Vanguard. It's a non-for-profit entity. They charge the lowest fees they possibly can. And some of those funds are just fantastic. And you can't get them outside an industry fund. The actual IFM business itself, which is owned by the funds, is worth a lot of money. But again, so it comes back to it's not one or the other, but it really does pay when you take a long-term view. And I think it'll be something that plays a big part in how super is managed over the next 20 or 30 years. However, it is extremely important that everyone's held honest on their returns. And I'd say that we've got a fairly decent regulator that at least tries to do that. And let's not forget as well, like there's one side of the political divide which is pretty vocal about not being a fan of industry funds. There is a lot of scrutiny that these funds go through year in, year out. They went through the Royal Commission too, and they came out with a clean bill of health. So it's a fair argument that, which is a common line wheeled out, how realistic are these valuations? And I'd say it's a very fair question, but I'd say what's a lot more indicative is who's asking that question and why. They really just want to do it so they can put you in a portfolio, which again, if they're half good at what they do, will have a ton of unlisted assets in it anyway.
Do you have a side hustle? My side hustle is websites, a form of digital real estate. If you want to learn more about this lucrative side hustle, check out my review of the E-Business Institute and their online self-paced courses. They cover everything from total beginners right through to advanced web design and how to buy, renovate, and sell websites for profit. As a graduate of Matt and Liz's courses, I can't thank them enough for the valuable web skills they gave me, and now I enjoy growing my portfolio of websites for income. Captain Fi listeners can register for free access to some of these courses by signing up using the link at www.captainfi.com/ebusiness-institute-review. Build your portfolio of digital real estate and start using websites to make money today. So it might be opening a can of worms here, but we've talked about wrap accounts through your advisors. We've talked about retail funds and talks about some of the benefits of industry super funds. What about self-managed super funds, like the old SMSFs? And I say that, and I've already probably got a negative bias towards them because most of the time when I hear SMSF, it's somebody trying to spruik me property through my super. So there you go. I probably already tarnished it, but yeah, mate, what can you tell us about SMSFs?
I've dealt with a lot of SMSFs over the years. So whenever you work as a stockbroker, typically those kinds of businesses are very biased towards SMSFs because it means that the business can design a product that's got a lot of managed accounts, it's run by the brokers, and it's a real gravy train for the business. But the answer's simple. I would say 99% of the time, if someone's telling you to set up an SMSF, it's in their interests, not in yours, or they're either just hopelessly not aware of what better things are out there. So, whenever you hear horror stories with super funds, 9 out of 10 times SMSFs are involved. They're complicated, they're expensive to set up, they're expensive to operate, and they're expensive to close down. I deal with them all the time, and it's almost the same thing every time. I'm in this complicated piece of garbage. Please help me get out of it, and it takes quite a while to do that. But yeah, just by and large, other problems with SMSFs too, it's a common intention of people is to access property via that. My looking on bias, I've always worked in, breaking houses and the like, so I've got a real bent towards listed investments as opposed to direct property. But super and property, in my opinion, is like oil and water. The two just don't mix. They're horrible to combine. But yeah, SMSFs, by and large, they're expensive, they're complicated. They typically expose you to less consumer protection. So again, going back to that example of a financial advisor puts you in a portfolio of funds, I've got to go through what's called an investment wrap or a wrap account, whatever they might call it. In order to be one of the 800 odd funds on that products list, you've got to prove that you're not doing illegal stuff and that you've got a rating agency behind you and that kind of stuff. Versus as soon as you get into SMSF territory, like by and large, you can go invest in whatever you want. You can buy a collectible car or a coin collection or stocks or whatever. And again, so it's a lot riskier. Also, just inherently complicated. And fundamentally, like taking it all back, they don't do anything that you can't just get through a decent fund. So if you want to have an active approach and play a part in managing your funds, wonderful. There's probably a really good industry fund that can help you do that, whether it's buying ETFs yourself or taking your own approach to the infrastructure fund or the shares fund or whatever, or active or passive. So it's purported that they've got more control or they give people more control. And to that I say, not in my opinion. It actually gives you a lot less control because you're a lot more reliant on having an advisor and an accountant and prohibitive costs and just complication. Yeah, there's no compelling reason to maintain one. And again, as I say, I've dealt with them throughout my career and I still get clients with SMSFs all the time. And more often than not, the question is, do I still need this? And the answer that we get to at the end of the process is absolutely not. Because the other thing with SMSFs is, look, it's not impossible, but it's a lot harder to find just do it for me, set and forget. Because again, in that admin fee from a super fund, they're doing your tax return, they're handling all the administration of it all. When you're in an SMSF, you've got to do it yourself, which you might get wrong. You've got to pay an accountant to help you, which it's also the case that I always find it terrifying that you could get, if you were just doing an exercise, you could get one person go to two different advisors and you might just get radically different quotes for what is literally the exact same piece of work. And accountants are a lot better than financial advisors. They're a lot less salesy, but still a lot of the firms that focus on SMSFs, you can see a pretty wide, broad spectrum of fees that people will charge. It might be as low as $1,000 a year. It could get as high as 4 or 5, and that's just the accounting cost. So yeah, before I rabbit on too much, I very seldom could ever even imagine a reason that someone would actually benefit from an SMSF. I can think of lots of reasons why advisors would benefit. I can't think of many, if any, why a client would, and that's after working with them for a long time.
Okay, so red flag firmly planted over SMSF.
Yeah. And there's a loophole that you can get some very salacious commission payments with property too. So if anyone's trying to sell your property and for heaven's sake an off-the-plan property via an SMSF, I would be extremely wary of that person. And the regulator has been pretty intense in communicating that they're not very stoked on advisors that go around recommending SMSF. So you'll find that some advisors, for instance, are a bit scared of recommending them because, again, the regulator actually takes an interest in which firms are recommending them by the bucket load because, again, historically speaking, they tend to result in higher costs and lower outcomes for clients.
So what are some other myths that exist around super?
Yeah, some common ones that I'm always complaining about is when people, for instance, might think that they're always changing the goalposts, which is fair. They are. I just hear a lot of people are really, it's the government's money and it's this, that, and the other. And the truth is they are always changing the goalposts and they will continue to. But what they're more than likely going to change is getting money into super, not getting it out. And the reason being that it is such a lucrative way to save tax and build wealth. And again, you've got think tanks and both sides of politics all over talking about just how much of a black hole for tax purposes super is. And, that is slightly different now as well. Like there are actual changes to the law, which means some people in certain circumstances might not have to focus as much on super in your younger years because there's some tax concessions that make it really efficient to just migrate wealth into super once you're in your 40s or 50s and you're more comfortable with that, time frame. Because again, the trade-off for super isn't one to ignore. You can't access it. It's so hard to access that you can declare bankruptcy and they can't get on your super. So for instance, you might get sued for doing something horrible. And if there's a victim involved, they can't even claim on your super. I think there's a movement trying to change that for victims of pretty heinous crimes being able to access perpetrated super. But again, that's how lucrative it is and protected it is. But again, you can't access it. So that's just one thing. They are going to continue to change the laws around it. But for most Australians, it's still going to be a fantastic way to build wealth. And one of the other ones that I've just always had a bit of a bugbear with that I just hear over the years is that they should get rid of super funds and it should just be managed by the future fund. In some part, the future fund actually is there to back up the defined benefit pensions of government employees and that kind of stuff. So in a way, it's true. That's absolutely not the case because you do want more than one option. You do want competitive tension between different funds, which will get better outcomes and push them to do more and get higher returns, get better, lower fees and that kind of stuff. And secondly, as well, the future fund is designed very differently from a super fund. I've only got, I think it's about 17% or something like that in Australian equities. And the whole point being they don't want to be correlated to the Australian economy. And second to that as well, their portfolio isn't designed to be as liquid as, say, a super fund or something like that. They're just a couple of the myths that I hear. And particularly on that first one, it is locked away for a long time. It's not something to ignore. But again, it's about just making sure that you don't waste the opportunity. So it might just be planning to attack your superannuation, so to speak, more in 5 or 10 years. But again, just making sure that you don't just ignore it because, again, there's nothing like it.
I mean, super's, I guess, holistically speaking, it's one aspect. It is a pretty big aspect, but it's just one part of financial advice. It's obviously important, and if you're interested in FIRE, your early retirement will eventually become a typical retirement, and you will eventually get access to your super. So it is something you need to pay attention to. But just quickly, on the other side, what are some other areas of financial advice that you would concentrate on to get some quick wins for your clients?
It's often some of the simplest solutions are the best. So, just helping people understand, are there ways that we can save tax is a really common one and a really easy one. Just helping people make decisions. So should I invest in outside of super, inside of super, a combination of the two? Obviously, we've discussed ad nauseum, the actual super fund itself. Yeah, it's really different. The more complicated someone's scenario is, the more you can do. So if you see someone who's got a really disparate income to their spouse, for instance, or they might own a business, or they might have a windfall gain from an inheritance or an asset sale or something like that, the more going on in someone, the more levers we as financial planners can pull. But again, I know I've created a book, conveyed a pretty grim take on just the financial services industry, but it's not hard to give good financial advice. It's really not. I'd love to say that I'm the smartest guy in Australia and it's super complicated. It's actually pretty simple. All you want to do is save tax efficiently, of which there's simple ways to do that. Again, tricky thing with financial advisors, think of them like GPs. They're kind of a jack of all trades, master of none. Like, I'm in no way, shape or form a tax accountant. I can give general advice on how to save tax and that kind of stuff, but you really do need to see an accountant if you've got some complicated tax affairs. But outside of that, just investments outside of super. Again, I'm sure this resonates with a lot of listeners. Huge fan of passive investing, particularly outside of super. Low tax, they're not constantly buying and selling stuff, so we're not getting hit with capital gains. Super low fee, very complementary by a lot of the stuff we try to do within. So just helping people understand how to structure those kinds of things. So, do you want it in your name, your partner's name? Is perhaps something like an entity like a trust or a company on the cards? You want to invest for kids or grandkids. How should one go about that? Again, pretty simple solutions. Again, my kind of philosophy on all this stuff is you should just pay for advice in the same way we pay for everything else when you use it. And I'd say often people don't need financial advice. I've just got to, sometimes I see people and they're 99% of the way there. So we'll just do an hour review and just talk about some general concepts and they're fine. They don't need a statement of advice. It's not going to add anything to their world. But equally, let's say you do go down the road of getting an SOA, and common reasons for that is, which is term for statement of advice, is whether you've just gone through a life event, like maybe you had kids or you're approaching retirement or you've started earning heaps more, a much larger income, maybe you've paid off your house, any number of things. Generally speaking, once you put it all together, you really shouldn't need to seek it again unless you want to for maybe 3, 5 years, maybe 5 or 10 years. Again, once you set up a good product investment-wise and super-wise, and you've got a clear plan as to how you're going to save tax and protect your assets, etc., it really should be the case that you don't need to pay someone a retainer because, again, you've got XYZ looking after your personal investments for a very fair fee, and you've got ABC looking after your investments in super for a very fair fee, etc. And again, if you do need tax advice ongoing, your accountant will do that. Unfortunately, it's not typically in the bandwidth of a financial advisor or planner or whatever you want to call them. So yeah, I would say that good things to look for in financial advice. If you do have a lot going on, retirement's obviously a pretty big one for a lot of people. Again, I'm a sucker for just reading books and blogs from other advisors. I just can't help myself. And a good line I heard from one was, planning your retirement is like playing a game of chess, except you really only have one chance at it, which isn't totally true. You can always change whenever you want, but it can pay to get advice there to just make sure that you are doing all the right things because you don't know what you don't know. The problem with that is, again, as I've communicated pretty thoroughly, that I think most of the time advisors aren't actually going to help you there. But yeah, so it's a range of things, really.
We've focused on a few of the shadier, ball-licking areas of financial advice. What are some of the good areas of financial advice, and what are the benefits that financial advice or getting financial advice, getting a statement of advice can have to someone and their financial health?
Oh, it's done right, and it's not that hard. You can really set yourself up. So if you are in a top performing fund, fortunate enough to be for 20 or 30 years, you'll retire with a lot of money. And if you get someone who can review your situation and figure out when and why and how you're going to use super as a tax structure, you can save a fortune in tax. And the exact same with investing outside of super. If you set it up right at the start, it can make a massive difference. And again, it's not all that dissimilar from super where there's just thousands of products. There's a million different competing interests vying for your attention with respect to personal investments. And if you just get set up initially, you may well find that you get really long dividends over the long term. And again, it's not a zero-sum game, right? It's not that if you choose one particular manager, which I don't think is as good as another, it's not, you're going to be bankrupt and everything's ruined. It's more just, perhaps you've had a little bit more fees, or perhaps under the bonnet, this company actually does these rather rogue things to generate returns. So what appears on the face value is a really low-cost product actually has a few kind of spooky things going on under the bonnet. But again, it doesn't mean that it's not going to work. It just means that, yeah, exactly, you might just not be aware of it. The reasons are it's really easy to set up. And also, one of the other things that just isn't well communicated is that everyone just seems to think, if you've got heaps of money, you just automatically shouldn't be in a simple super fund and a simple investment strategy, when you tend to find that is actually the best thing to do, whether you've got $6 million in financial assets or whether you've got 160 grand in financial assets. Often you'll find that the solutions aren't all that different. Depends how it's structured. But again, also just really punch that one of the benefits of the Australian system is everyone has super, more or less. And by virtue of that, everyone can access all of these really low cost, really high performing ways to insure yourself, save tax, invest for the future. And the same being said, particularly in the last 18 months or so, there's been just one or two things that have come out with respect to personal investing, which just makes it super easy to set that up long term. And again, if you know when and why and how you're going to do things for the next 5 or 10 years, you've got a plan, fantastic. You're not leaving anything on the table. And again, it can just set you up to what we're all out here for. So we don't have to work for the money. So you can spend your time doing what you choose to do.
Yes, financial independence, that's the goal. Look, it's been an awesome morning/afternoon chatting. I've only got a few more questions before I'll graciously let you go because I've used quite a lot of your time up today. But just on that concept of financial independence, now maybe putting on your hat as a bloke on his own journey to financial independence, what are your top 3 tips or your top 3 strategies in terms of getting the best bang for your buck, the best value? What are the top 3 things you should focus on?
Make sure you're in a top performing super fund. That's just number one. You're not overpaying in fees. You're not in a crappy investment product. Number 2, make sure you're saving tax where you can. Again, the Australian system has some just incredibly low hanging fruit where you can either save tax or, boost your returns. And similar to paying off debt, when you save tax, it's a guaranteed return. Doesn't matter what markets do, we get that money because no matter what. So that's number 2. And number 3, if you can just set up your investments correctly at the start, which again is incredibly easy to do, you'll be in the arena where you won't have to pay prohibitive ongoing costs. 1, find a good super fund. 2, have a plan as to how you're going to minimize tax. For a lot of people, maybe that's not possible, but for, I'd say, a good proportion of the population, it's quite achievable. And thirdly, just make sure that if you are investing outside of super, which I think a lot of people should for a number of reasons, that you just do it via a really low cost, high quality product, which I'm pretty certain a good portion of the listeners already do, if not all of them.
And you mentioned that you're a big fan of reading blogs, listening to podcasts, books. Do you have any top recommendations for books or any learning resources?
Not particularly. I'm like a bad gambler with forums and all that. But the thing that I've always found very entertaining is I don't think there's ever been so much good information and so much rubbish information out there at the same time. I'm not much into crypto and that kind of stuff. I'm not just poo-pooing that. But again, if you're getting advice on a Reddit forum or something like that, it's highly likely that the person typing that comment may be all over it and 100% correct, but they also might not be. The pain in the neck is that if you go and see a professional, as we've discussed for a long time, I don't think that they're necessarily going to put your interests first. So I think the best thing you can do is that if you are in a really top performing super fund, I think you'll find that they have, and they're getting better and better at this, which I think is wonderful. They've got really good resources online about what's going on in investment markets and how you should think about that. They've got really good fact sheets on what happens to my super when I die and that kind of stuff. And again, granted, they're not independent in the sense that they do want to retain their members, but they're also not trying to flog you an insurance product that's owned by the bank as well, or a mortgage that's affiliated with a product provider. So that's, I think, a good super fund is just a wealth of information. They're getting better and better, particularly with their own podcast, just for updating market performance. I'm loving a lot of the stuff that they're putting out. And thirdly, I think that there's a resource that's done by, naturally, my website, Independent Wealth Advice, iwadvice.com.au. It's world renowned for just being fabulous. And then one of the other really good ones, I think, is ASIC Money Smart. So that's like an online financial, it's not the correct word, Wikipedia, if you will, of Aussie finance, and all the things that make it up: managed funds, mortgages, insurance, super, et cetera, et cetera, et cetera. And I think they do a pretty good job of making it pretty readable. I think whenever you've got a question, you want to try and find a couple of different places to answer it. But I'm a big fan of Money Smart. I just think they do a really good job. I also quite like Super Guide. I think they do quite a good job. Again, show me the incentive, I'll show you the outcome. People like Choice and Super Consumers Australia and that kind of stuff, they're not a lobby group or anything like that. They represent consumers, and astoundingly, they tend to be closer on the money, so to speak. And then just anecdotally, I just personally love it. I'm really focused on markets and that kind of stuff. I just love Twitter for that reason. The amount of pretty well-regarded investment professionals that are on Twitter, there's a lot of morons on there as well, myself included. But yeah, just on the entertainment value, I think you see I think it's underappreciated how good the investment feedback you get up on particular stocks on Twitter.
I've been blown away by some of the conversations that even I've been able to get in touch with people. Like I remember getting in touch with people that run these companies. Even when I've had guys and girls come on the show from companies, like Six Park, StockSpot, and other like investment brokerage firms. And often I've just reached out via Twitter or Instagram and they're like willing to talk to me. And I'm like, oh, perfect. You never know unless you give it a go, right?
Oh, exactly. Yeah, and that's one of the exact same. I've had conversations with and met people via Twitter that I otherwise wouldn't have. And again, yeah, I just find it very entertaining. But yeah, I think Money Smart's a brilliant resource and so is a top flight super fund. But yeah, unfortunately, neither of those two will ever lead us to meeting very interesting pioneers and tycoons in the industry.
Look, I like the Money Smart website too. I think it's good. I think it's definitely going in the right direction. But I remember this is one thing about fees, and it was just like an example. I can't remember off the top of my head what it was, but it was normalizing. It was like a 1 or a 2% fee or something. Andy pays 2% in fees on his super and blah, 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 blah. They were giving a worked example. And just from going through Eli's worked example on the 1% fees over 40 years, you end up losing half your income in retirement. I was a bit shocked that they were normalizing that. Anyway, we provided some feedback.
Just on that though, and good on you, like in all seriousness, for super funds charging you 0.7 or 0.8, that's not necessarily a bad deal because again, fees matter, fees really do, but just because a fund charges 0.5% more, and honestly, there's phenomenal funds out there that will charge you close to 1%, but what you're getting for that is an incredibly good investment solution. And so you can't just say carte blanche that just because a fund charges 0.5% more that its return will be 0.5% less. It's the value that you get for that. But yeah, and that's just because, there's funds that I love that will charge 0.7%. And again, I think people get cracking value for that. And that's all inclusive. That's everything. There's no advisor fees or anything lying in there.
Oh, it's the fire dogma, mate. Oh, it's that index fund life.
Yeah, and as I say, in my opinion, it's the second best way that you can invest your money. So is anyone going to turn around and just, throw their hands up in the air and be miserable as a result of that? I can't foresee a scenario. It's a fantastic way to go about it.
Yeah. Hey, mate. So speaking of fantastic value, give us a plug for the business, mate. Tell us a bit about what you do, services you provide, and what services you could offer to the FIRE community or someone on the path to financial independence.
Yeah, independent wealth advice based in Sydney, office in Martin Place. By virtue of technology, I'd love to say I have a client in every state, but I don't have anyone in the Northern Territory, and I'd love to be able to. I'm almost considering running some Facebook ads there just so I can say that. But again, I'd like to think that I'm a little bit different in the sense that it's not an ongoing fee piece with us. It's more about just getting people set up. And if people want to meet with me on an ongoing basis or they do have something going on that they do need to see me regularly, it's the case that you just pay an hourly rate or you have an agreed upon hourly amount of time. So that's one thing that I just do quite differently that I think is a bit of a no-brainer, to be honest. And outside of that, I also pride myself on what I think having a solution for anyone. So we've got dealt with clients well north of, in the multiple millions in investments, north of 5. And then equally, we've got a lot of people that are just quite everyday Australians. And again, at least with me, if I see someone and they're already in a good super fund, they're already pretty much structured correctly, my little line I always say is good for you, bad for me, because my perfect client is someone who's in a retail fund or a poor bank fund, or they're paying advisor fees, and they come and see me and they basically say, look, XYZ is such a nice person. They've got this beautiful office that overlooks the harbour or the river or whatever, and they seem really nice, but I can't quite figure out why I'm paying this person thousands a year or tens of thousands a year. And I say, yeah, I'm sorry to tell you, but you're actually not getting good value. I spent a lot of time and money trying to make the website as interactive as possible. So it's just the case that tries to outline you're going to be a good client. Very simple process. Drop me an email, drop me a call, book in via the little bookie thing. It's just iwadvice.com.au. It's Andy at iwadvice.com.au. We've got a 1300 number and an 02 number and all the rest. And again, the point being that I really do pride myself on it. It's not just a default. Everyone goes into the same cookie cutter advice of conflicted products. It's about doing things right for people. And also, I do spend a lot of time, sometimes a little bit too much time, blogging about things that I think are interesting. And I'm personally very interested in fees. If you ever check out the blog from time to time, because there are plenty of examples of specific companies that I write about, and some of those companies aren't particularly enthused about that. But yeah, so by all means, subscribe to the blog or the newsletter, and hopefully, if you don't need advice, you can at least get an entertaining update and keep abreast of changes.
Awesome stuff, mate. I'll make sure we'll include all of those links in the show notes as well. So if you're listening and you want to head over and check out Andy's site and his business, jump onto the blog and scroll down to the bottom. There'll be links to Andy's website and some of the entertaining blog posts that he's written recently, which set up the hornet's nest. Always good to see people poking the bear. Found his latest one's quite entertaining. Andy, mate, again, thanks so much for your time. Yeah, just really appreciate your time, mate, and your experience. You're obviously a wealth of knowledge. I personally really appreciate what you're doing. You're not out there to rip people off or bullshit them. So good on you, man. And I really hope the business model works for you. So yeah, I'd encourage, if anyone has been thinking about getting some advice, hit him up. At least he'll be honest enough to tell you whether it's actually going to be worth it or not.
100%. And thanks for having me. I'm a big fan of the podcast, the blog, and I love this. Financial advice is the love of my life. I love talking and talking about it, so it's a pleasure.
Mate, it's been awesome, and enjoy the rest of your Sunday.
Thanks so much. Appreciate it. So just one piece of housekeeping. All the information we discussed in this podcast is just factual information and at most general advice. And what that means is it doesn't take into account your specific needs or circumstances. And so you need to consider your own financial position, objectives, and requirements before making any decisions. And ideally, you should seek financial advice. Independent Wealth Advice is a corporate authorized representative, and I myself, Andrew Darroch, am a registered financial advisor as well. Thanks.
Thanks for listening to another episode of the Captain Fi Financial Independence podcast. To read the transcripts or check out the show notes, head over to www.captainfi.com for all the details. If you have a question for the captain, make sure to get in touch. You might even make it on the airwaves. You can reach me online through the Captain Fi contact form or get in touch through the socials. I'm active on Facebook and Instagram, as well as a number of online finance and investing forums. And finally, remember, the information presented on the show and the links provided are for general information purposes only. They should not be taken as constituting professional financial advice. You should always do your own research when making any financial decisions and make sure it's appropriate for your personal circumstance.